Good morning. On behalf of CEPS and ECMI, welcome to this webinar where we will be presenting the results of a task force group of industry leaders which have come together over a period of 6 to 8 months to reflect about the future of capital markets in Europe, from the finding that we thought that progress towards more market finance has been insufficient and what we could do about this. We will be presenting the results of this task force now. This was a task force, as I said, with 8 industry leaders chaired by Lieve Mostrey, who will be presenting the results in a moment, followed by my colleague Apostolos Tomadakis, who was one of the rapporteurs for the task force, who will be briefly presenting our findings or substantiate our recommendations in a moment. As I indicated, we believe that, and that's, I think, a finding which is shared by quite a number of people, certainly here in Brussels, but also elsewhere in Europe, that we have not made sufficient progress in, amongst others, the Capital Markets Union program to realize more market finance in Europe as compared to bank finance. And that's why we thought, why not bringing together a group of 8 industry leaders which are active in the sector, but from different angles, to sit together and to reflect about this and to come up with some findings, which we have grouped in a few recommendations. The intention was, and the initiative was taken by us, then sponsored by principally Euroclear, to have some, above all, big picture issues, some big ticket items. What should be done? Not a long watch list of all nitty-gritty. No, we want essentially to present what we think are overall recommendations we should be pursued by policymakers, but also by markets in trying to achieve more market finance. As I said, the group was chaired by Lieve Mostrey, who's Chief Executive Officer of Euroclear, but we also had 3 exchanges in the group. We had SIX, London Stock Exchange, and we had Nasdaq or Nasdaq Europe in the group. We had 2 banks, Santander and BNP Paribas. We had an asset manager, and we had a non-financial corporate, the chair of a large beverage group. We had 3 rapporteurs. We had Apostolos, whom I presented already. We had also Nick Maloney, who could unfortunately not join us today. And we have myself. We have worked on a report, which we now openly present today. We have come up with only a few findings, but I think the report presents plenty of in-depth research on what we see in European capital markets, which evolutions we see, and what we think, what could be examples, what we call ecosystems to stimulate more market finance. Our report is entitled Time to Re-energize Europe's or the EU's capital markets, and with the subtitle Building Investable and Competitive Ecosystems. So it is about 40 pages. So as I said, we want to have a snapshot of markets in Europe, compare it with the most important other markets, and then to come up with some findings, which we'll now present in a moment. And I pass the floor to Lieve to present this, whom I would like to thank to chair this group, because it was an interesting exercise. We met with these 8 people and with the rapporteurs over this period of 6 to 8 months, and had really very good in-depth discussions. So it was an interesting way to work together, Lieve, and I hope, let's say, it can be an example, also a way by which we can advance market finance in Europe. For those who do not know Euroclear, Euroclear is based in Brussels, is a central international central securities depository, active since many, many years, a very important company here in Brussels, but also active all around the globe, very active in, as a securities depository, but also in related activities to securities settlement. So I pass the floor to Lieve, who can present the main findings, but also a bit her views on the subject. After which we have Apostolos to present a bit more the in-depth research which we have done for this report. After which we can have Q&A. You have a Q&A box at the bottom, but you also have the chat function. But we will also try to bring up some members of the group who are joining us also virtually today to give their insights. I think, as far as I know, Alan Pollack, who was before the head of a large Danish pension fund, will join us, but also Luca Caravoglia, who's the chair of the Campari group, will join us, and probably some others, but they can raise their hands and then we will bring them on the screen. But of course, you can also in the meantime raise questions, which I then will take up after the initial presentation around 10:30. Lieve, the floor is yours.
Thank you, Karel. Good morning, ladies and gentlemen. It is a great honor for me to introduce the results and the recommendations of this working group. I believe we all acknowledge that in today's economic environment, there is a massive need for investments, be that for the green transition, be that for the digital transition, be that for further recovery from the COVID crisis, be that for the strategic, economic and defense autonomy of Europe, or for the reconstruction of Ukraine. And so with these massive investment needs, it will be paramount for Europe, for the governments, for the companies, for the SMEs, and for the citizens, that we are collectively able to source the funding required for this in the broadest and in the most efficient way. So today's studies demonstrates not only that the European capital markets are still lagging those of the United States, but even more that the gap is widening. The study also demonstrates that there is a quite big divergence between parts in Europe when comparing the Nordic markets, when comparing Western or Southern Europe, or Central and Eastern Europe, the stage of advancement is very different. So the working group has taken these realities as a starting position in order to develop 7 recommendations that we believe will contribute to what I would call a pragmatic and measurable approach to really grow both direct and indirect capital market financing. So the first recommendation is to acknowledge this diversity of the different capital markets, but to state that growing and developing each and every one of them is an essential step before integrating across Europe the capital markets. Secondly, what we have seen is that the most advanced markets in Europe have been successful to mobilize the long-term savings of the retail investors, and this through both investments in financial literacy and in creating fiscal incentives. And so we believe that retail investors have to be at the core of the strategy to develop the European capital markets. Thirdly, such development of the different capital markets will also require mutual recognition and interoperability, because this will then further support the efficiencies and the scale across those markets. As a fourth recommendation, we believe that those markets can only grow and develop when they operate with open access and with a stable and predictable regulatory and supervisory environment. And that stability and that predictability are also key contributors to success for those markets. Now, in order to reach these goals, the working group has also worked on a number of tools, and there has been focus on 3 sets of tools. And the first one is that we strongly believe that you need to measure in order to know. And we believe that developing a limited set of KPIs that will measure both the competitiveness of the EU actors, because without competitive actors, the markets will not flourish, and compare that with non-EU actors. And on the other hand, also have clear KPIs that will measure the development of the attractiveness of our European markets versus the non-European markets. So that is a first tool set to develop these KPIs. Then secondly, we believe that it would be helpful for our policymakers that they are on a regular basis in contact with a consultative or advisory group of really market actors that can report on their findings as practitioners in order to have what I would call kind of a permanent testing of theory versus reality. And then as a third tool, we have also been thinking about facilitating and monitoring the increases in market financing, both direct and indirect, by using or developing a funding escalator that will really monitor the progress on this market financing for the different actors in the ecosystem. We also think it's useful to develop an investment riskometer, as it has been called by the teams, to really assess the participation of retail and institutional investors in the financing. And we believe it's also very timely to facilitate further and more intensively the framework for securitization in order to make sure that we maximize the bank's capacity in their contribution and that we can boost the demand for securitized products. So this is an overview of the 7 recommendations that the working group has made. And before handing over to Apostolos, who will go into more details and give you more insights, I really want to thank, first of all, the members of the working group for, as Karel said, the very insightful discussions across the different parts of Europe, and also the teams of ECMI and CEPS for their precious support and for the in-depth analytical scientific work and the documentation that you will find in the report. So thank you, and Apostolos, the floor is yours.
Thank you very much, Liv, and thank you very much, Karel, for that group, for setting this group and for the discussions. I would like to share my screen. I have a few slides. I hope you can see it. Can you see it?
Okay.
Yes, perfect. Just to, let's say, confirm also what Liv said, I mean, what is the aim? We have to think, okay, what we want to achieve with European capital markets. We want to have deep, liquid, and efficient capital markets, meaning low costs, where all market participants with the same relevant characteristics face the same set of rules, and they have equal access to financial products and services, and also treated equally where they are active, where they choose to be active and invest. There have been several waves of action plans, starting back in 2004, to the CMU, to the most recent new action plan, several communications and packages, a lot of advices from the ESAs, consultations, evidence, impact assessments. The tasks also for ESMAs have been enlarged, and they are expected also to enlarge in the future. But there is a however. European capital markets are lacking ambition, scale, and strength. National capital markets, as Liv said, they are developed in a very heterogeneous way. The participation of retail investors is very limited. There are several reasons contributing to that, partially because they're not available long-term saving investor products available to retail investors, or because the participation in the market is complex, the risk-return payoff is not attractive to them. So there are many reasons contributing to that. Next, we have a lot of dozens of market infrastructures, regulated markets, MTFs, venues, CCPs, CSDs, exchanges. So there is a very complex set there. There is a heterogeneous and a multi-level legislation. There is a divergence in supervisory interpretations. Those capital markets, European capital markets, are fragmented. It makes it difficult to access capital at all stages. Then we have the question about competitive and attractiveness, as Liv mentioned. But for that, we need to have the measures, the right measures to track how competitive and attractive are the European financial actors, but also the European capital markets vis-a-vis their international counterparts in US, China, Asia, and so on. With Brexit, we have the feeling that we've lost the voice of a global financial center from the policy-making debate arena. So that's a very important voice that lost. And also, last, there is insufficiently developed ecosystems. So very often SMEs have to rely, of course, on bank financing for different stages of growth because there is no other capital alternatives available to them. So we need to develop also more market ecosystems. So just to set the scene, I mean, and comparing a bit EU, the US, that's perhaps the only comparison of EU-US, then the rest of the report focuses exclusively on Europe, within Europe. So here what we see is the structure of financial sector in the two parts of the world, in the two capital markets. We look at the bank credit, the equity market, but also the bond market. And what we see in Europe, all three of them account about equally 80–90% of GDP. On the other hand, in the US, the bank credit has remained stable at 50%, while the other two capital market segments, if we call them, they have expanded a lot and now account for more than 200% of GDP. So on one hand, we have the bank-based model, and on the other hand, we have a more market-driven model. Now, if we focus more on capital markets, on the debt securities and the public equity markets, and zoom within EU, a lot of this analysis that we do is to look across European regions. So what we do, we look across the 4 different, let's say, regions in Europe. What we see in 3 out of the 4 regions, the share of debt markets as percent of GDP increased from 2015 to 2021, from the beginning of the CMU action plan until today. And it is approximately 2 to 3.5 times larger than the share of equity markets. But on the other hand, opposite to that, in Northern Europe, so in the 3 Nordics, Sweden, Finland, and Copenhagen, and in Denmark, the size of debt markets, and as a result, the equity markets also are now bigger and play a more important role compared to the debt markets. Now, if we move and look at the pre-IPO risk capital investment, here what we see actually illustrates very clearly the fragmented nature of the market. Pre-IPO risk capital investments as share of GDP in the Nordics rank well above the other 3 European regions. This is also evident when looking at the IPO market, at the number of IPOs and at the capital raised. The European IPO market is traded in a few member states, in particular the Nordics. We have the Nasdaq, Stockholm, Helsinki, and Copenhagen, that they account for the vast majority, both in terms of the number of IPOs and also in terms of the capital raised. And if we move now to the listed equity markets, the table on the left-hand side shows the number of European countries, the number of European companies per country, that they are in the list of the top 100 companies globally in terms of market capitalization. And we do a comparison between 2015 and 2022. These figures refer to March 2022. So what we see here from 2015, when 16 EU27 companies were part of the list, the number has dropped by half, just 8 companies in 2022. They used to account about 11% of the total capitalization, but now they represent only 5%. In addition, there are also different levels of development in European equity markets, as we see on the right-hand side. The Nordic countries are considered to have a fast-growing and more advanced stock markets. The combined capitalization of the three exchanges, the three Nordic exchanges, as a share of GDP increased fourfold since 2022. At the same time, the stock market capitalization in Western Europe has doubled, while it remains stable at the other two, at the Central Eastern Europe and in the Southern Europe. So we can see that there are a lot of different levels of development across different segments of the markets. Now, moving to the listed debt markets, here again, we can identify different models. We can identify three different models of European debt markets. In the first one, which includes the Central and Eastern Europe and the Southern Europe, is characterized by high levels of government debt to GDP that are more than 2.5 times the size of debt issued by financial institutions. Then we have the Western Europe, which we have a kind of an equal balance between the two. And then there are the Nordics, which, of course, there is a different story there. They're significantly dominated by financial institutions' debt, while also they exhibit the largest corporate segment compared to the other European regions. Now, securitization, Liv mentioned that. I mean, it's fair to say that securitization market in Europe doesn't exist. As of 2008 and the peak, the market has really declined and remained constant, never really recovered compared to the US. There are several reasons contributing to that, both from the demand side on how attractive is this product to investors, corporates, institutional investors, insurance companies, but also to the supply side for banks, how attractive, how efficient are securitized instruments so that banks can make loans more marketable and free up the capacity to lend to those that they need it. Last, we looked also at the household's financial assets. And of course, again, we have different levels there. Currency deposits account for the highest share of financial assets in Central and Eastern Europe, but also in Southern Europe. But then we change in Western Europe, more assets allocated to insurance and pension funds, while in the Nordics, they have also one of the highest equity market participation, which observed in EU. Of course, there are different reasons for that, either because of the maturity of capital markets, as we saw earlier, or the pension system, or the financial literacy of the citizens, as is highlighted in many studies. So I'm not going to repeat. Here is again the solutions, but I'm not going to repeat. This is what Liv said, the 7 recommendations that we put forward. But I'll stop here, and I'm happy to answer any questions you may have.
Okay, thank you, Apostolos. Very interesting presentation where you see we try to analyze a bit in a different way what we have been following in capital markets for a long time. But above all, this distinction which you have between these 4 groups in markets in Europe, as well as at the supply side, as well as the demand side, where you have a rather different picture. And where you see that, we have strong differences in Europe, but which also provides eventually some examples for policymakers on which way to follow. As I said, there are some members of the group present. If they want to join us and eventually join in the debate, I know that also Philippe Bordenat from BNP Paribas Group has joined, but if Alan or if Luca Garavoglia wants to add something to this, please raise your hand if you can do it, and I will, in the meantime, look for questions. I have already one question from a participant, but please feel free, let's say, to raise even more questions. One of the questions was, for example, at this stage, how an escalator will work. But I will look around if there are other persons who want to raise a point. I see Alan wants to raise a point. Alan was, until a few months ago, the head of the largest, one of the second largest Danish pension fund. So Alan wants to raise a point. Please put on your screen, Alan.
Yes. Hello, good morning. Tell me, Carol, can you hear my voice?
Yeah, very good.
Picture? Good, excellent. Yes. Now, first of all, I think it's very important to highlight that this material we now have in the report is fantastic set of data. I have my highest acknowledgement of the work you've done at CEPS than Apostolos have done in collecting this data. So I truly hope that the data itself can be used across Europe for debates and discussions, because it's a fantastic quality. So let me highlight that from the beginning. But when we come to the debate we have had and the recommendations, I would like to highlight also, with part of the experience I have, which comes basically from mostly from the Nordics. I've also worked across Europe, but mostly from the Nordics. And that's related to the acceptance of the capital markets and risk capital. And I would put it further, the journey from accepted to really acknowledge that this is so core for competitiveness in Europe. I too often meet opinion makers and very senior persons in Europe that somehow do not fully acknowledge this. And this is very, very important for our future. As Liv said at the beginning, it should finance the digitalization and the green transition and the core competitiveness. I think the comparisons we have here in the material towards US, I mean, is very, very significant, that we are simply lagging out. And the ranking of top companies and rank top 100, the decline now down to only 8 and 5% of the capital is really a big challenge and is heading in the totally wrong direction. But let me come back to risk capital, because we need to engage the retail investor, the savers in Europe. And there is again this viewpoint that we want to protect the savers. It is true that it's an important pillar in Europe that consumers need to be protected. However, that's not contradictory to that they invest in risk capital. It should be done in a proven way. And here we have an important way and a journey that we have to convince all stakeholders that this is not contradictory. You can invest in a prudent way in risk capital and still be protected, though you are not guaranteed, but you are protected, particularly by the transparency and the quality of the product, the way the products are regulated. And the more you get into listed setup, both for equities, but also for the corporate bonds, the more it will be highlighted the need for transparency, what is required to be listed, etc. So there is not a contradictory between protecting and investing in risk capital. And that is basically the journey we have been through in the Nordics. First of all, Sweden. It took some time for my home country, Denmark, to understand that this linkage is there. But I will say in the last 10 years, it has proven that we can have that journey. So there's a high level of protection still, despite it supports the risk capital and then the ecosystem that is so well described. So no, this is not really a question I'm putting forward, it's more common, but I think it's very important, and the KPIs you're putting forward and which I fully support, we have not defined them, but I think that's part of the dialogue now with the important stakeholders. How should we define them? So we have quantitative measurements to see that we gradually are improving in this very important area. Thank you so much.
Okay, thank you, Alan. Very clear on these 3 points. I mean, the competitiveness, which I think is extremely important, as you say, and Apostolos has to show these figures, extremely important, and we should be aware about this. And I think that was also a feeling in the group that there is insufficient awareness amongst policymakers, certainly here in Brussels, about how crucial this is for European industry. The second thing, I mean, this protection of savers, even of investors, is also a very important part where of course, the regulatory setup comes into play, where you speak about transparency of listed companies and all the information which they publish, the disclosure, which is a fundamental element of capital markets. And the third element being KPIs, I mean, having measurement tools to see how we advance in a certain direction. I see whether there's any other of our members who wants to comment, who wants to bring up a point at this stage. Thank you, Alan. I don't know whether Luca or Philippe wanted to raise a point.
But just perhaps, Karel, I can reply to a question. I mean, there is one question about the funding escalator and how this would work. I mean, essentially, this would be kind of a monitoring tool to help us access or to help us find what are the options that are working, which are the local, let's say, ecosystems, which are providing certain types of financing. For example, we'll be able for both the demand side, those that they need capital, but also those that they want to invest, to be able to see where and in which countries, in which member states, there is for example, a crowdfunding or a business angel or a venture capital, private equity. So will help us, let's say, find local, let's say, examples, local experiments that can be helpful and potentially at some point be scale up to a broader European level. So successful examples that can be of use for both those that they want to invest and those that demand investing.
For me, a funding escalator is also a way to measure what kind of products exist in a given market towards going as towards market finance, but also to identify the gaps in certain markets where, for example, you look, there are different ways, and there's, I mean, there's a nice design about this in the report, where you can see that you can step up from business angels, private equity, to venture capital, to unlisted equity, listed equity, to have additional rights issues, that you could have a measurement, a permanent measurement, which is where are we in a funding escalator in different markets, but that you can at the same time directly see which are the gaps and what is missing in a certain market, which is then a tool for policymakers to see, look, we have to focus on, for example, development of private equity markets, venture capital markets, or we are missing IPOs in our markets. We have to do something about this, try to investigate what is the problem, why are companies not going to the market. That is the way we see a funding escalator to work, just to make it visible for every market in Europe. What are the problems? So where a market is successful, and of course we have focused a lot on these Nordic markets, which are doing very well, but there may be others as well which may come up, or there may be others where we see, look, they have a lot of listed equity, but insufficient new equity in the pipeline, for example, or they have a well-developed debt securities market, but not a well-developed equity securities market. I see another question which has come in the meantime, or two other questions. I see a question from Philippe Molitor. Could you specify the three main factors on the demand and the supply side that prevent securitization markets for developing? And for which segments would securitization markets be most promising? For SMEs, for example, for climate finance, or for mortgages? Can you take this, Apostolos?
Yeah, I mean, what we are saying about, I mean, if we look first of all at the demand side, I mean, why these type of products are not so attractive to investors, to corporates, to institutional investors, so insurance companies. So you may want to look, for example, there into Solvency II and see how these products are treated. They can also be about, you know, how the regulatory equivalence, let's say, between these products in terms of capital treatment with other similar type of products, but very different, like the covered bonds. We see the covered bond market has advanced, but not the securitization market. So in a sense, how we can make this more easy for banks and more attractive for them to use them in order to sell loans, make them more marketable to SMEs, mortgages, or for different purposes. So there are certain things within the STS framework that can be corrected or can be make it more attractive, because it's also a matter of long-term growth of European economy, which is at stake. So that's what we see as being more important there.
Okay, thank you. There was also another question from Cosmina, former colleague. What is, from an asset allocation perspective, how could this proposed risk barometer feed into the retail investor strategy by the European Commission, which is expected to be presented early next year? I mean, a thing in which we want to clearly feed into, because we say, also Alan mentioned this, the importance of retail investors, which we clearly see in the Nordic markets. How could such a risk barometer or a riskometer, as we call it, help Apostolos?
I mean, for the risk barometer, I mean, the idea is to have a tool that can be used to clarify, let's say, the types, characteristics, risk return payoff of investment products, see the gaps, see which products are more complex, which products are not, let's say, preferred, or they are not attractive to retail investors, for which reason, what are the obstacles. For example, we often discuss about ETFs and how easy and useful products can be for investors, but we hardly see them advertised by banks, for example. So, of course, there are reasons for that, but you know, the risk barometer will help us identify that based on the risk profile of the investor, which are the products that may suit best his risk appetite. And of course, with this, we can do it also across regions and see what works, what not, and what are the gaps, as you said, Karel, also for the funding escalator. So a help to identify what works and what not in terms of retail investment products.
Indeed, it's our ideas with this riskometer, that there is a kind of a very easy way for a retail investor, a non-professional investor, to understand which products suit his profile, but also as he has an investment portfolio, to realize which are the risks to which I'm subject, which you can do again in an escalator with the very low risk products at the bottom and the very high risk products at the top, but then each time with different steps. We know, for example, that within MiFID, we have something which is called the suitability and appropriateness test, which says, look, you as investor, in what can you invest? But we know that listed security has a fairly low risk rating and other products may have a higher risk rating. So there is some nuance needed and certainly some help towards a retail investor to clearly guide them in what he can invest. If you think, for example, at what is today very topical in the news, cryptocurrency, which apparently many Europeans have also invested in, I think crypto would have been at the top of the riskometer. And if we were to have indicated all the time to investors, look, watch out with crypto, this is a very risky product because it's basically not regulated at all. That could have been a help from policymakers to investors to say, look, if you invest in this product, you have to know that you can have, I mean, all your investment lost, which I think has happened certainly for many of them today. I'm looking around for further questions or further comments, so please do if you have further comments to raise. If not, I can indicate one issue, since Niamh Maloney, who's one of our rapporteurs, who's professor at London School of Economics, the issue which she strongly felt was that we have in Europe to come, and that's our fourth recommendation, to a stable securities market regulatory framework. Niamh Maloney is the person who's published a book, one of the only persons who's published a book, a whole book about ESMA, what ESMA has done. But the feeling is, and which we discussed strongly in the group, is that the regulatory environment in Europe for securities markets has become a bit unstable because of a continuation of reviews and amendments, and also of a process of pushing far too much what we call in European language to level 1, that almost everything is regulated on level 1, which is then a part of an amendment or a proposal from the Commission, which is discussed in the Parliament and in the Council, but that we don't leave enough to level 2 or level 3, where we have, in fact, much more flexibility to adapt the regulatory framework. So it's also something which the ECMI members, which we discussed 2 weeks ago, feel very strongly about, that we need to come to a stable regulatory landscape for securities market in Europe, which is extremely important. And that we need to have securities supervisors, which need to use the tools of the peer reviews to streamline supervisory structures. We are aware that ESMA is starting to do this, but I think there is a lot which remains to be done in this domain. But we certainly, as ECMI, continue to work on this and work even more on that. I see there is another question here. What about public markets and how could they become more attractive for SMEs to strengthen capital markets union? How could this happen through this listing act, which the Commission is as a kind of an amendment to the prospectus regulation, intending to propose next week? Are capital markets suitable for SMEs, is a question, Apostolos.
Yes. I mean, the first part of the question, would making public capital markets more attractive for SMEs be pertinent to strengthen the CMU? Yes. I mean, capital markets, yeah, have the potential. I mean, it's an option, an alternative route, a route that SMEs have to raise capital that they need. Of course, the question is whether SMEs using capital markets or not. That's another question. But then we have also to think about, okay, is it attractive to them? How easy is to access capital markets? How complex or not it is? I mean, one thing that would be interesting to see will be a kind of an analysis or an assessment of what is the cost of an average SME in Sweden, in Czech, in Bulgaria, in Italy, of going to the public market. So what is the cost of the administrative, the legal cost, the listing cost and everything? Just to have a number, have a figure, know, okay, the cost of an SME is about 5, 6, 7, 8% of the capital that wants to raise. And then having that in mind, we can go ahead and propose changes to the listing act, to the prospectus regulation, to market abuse, in order to make it more attractive to them. So otherwise, I have the feeling that we'll go in this endless, let's say, loop of amendments after amendment, changes after changes, which they don't have a real impact, because we are missing the fundamental thing, the basic. Have an analysis and impact assessment, knowing exactly what is the cost, what are the complexities, and then go ahead with proposing different measures and regulations.
Okay, I see that Alan wants to add something here, because of course the Nordics have an enormous experience in bringing SMEs to the market.
Yeah, and I so much like the question about the SMEs, because European corporate structure is by far dominated by SMEs, actually many privately owned SMEs. And we have an enormous challenge on this just alone, but for the change of generation, that ownership change. I think we have a need to understand the journey. It was before raised the problem of funding escalator, that you understand the journey an SME can go through. Doesn't have to be one step towards being stock listed. We have what we call the pre-IPO, the various ownerships. And very importantly, that you do not need to give up full control of ownership because you get listed. I think there is a misinterpretation somewhere that you need to comply with what is required to be listed. Now we're back to the transparency, that you need, of course, to deliver a lot of information to the market, etc. But you don't, from an ownership perspective, need to lose control, which, of course, for many family-owned SMEs is a very important thing. It's a journey where you stepwise move on and can take decisions. On top of that, you have what some call the anchor investor. So you can also invite a long-term anchor investor in, That's where it's very important to have institutional investors. They often act as an anchor investor for a period. It can be in pre-IPO and it can be more long-term, combined with being listed. So there are many models in how you actually, as family-owned SME, can have this journey towards gradually being listed, but you keep control, and then maybe gradually you want to get a higher proportion into the listed market. That's entirely up to the owners. I think to make that journey clear is a very important role we have, and that has taken some time in the Nordics, but now we see that it is actually a high number of SMEs that are going public as part of their journey.
Okay, thank you, Alan, for this clarification. I probably go back in a moment to leave towards the end, but what I wanted to do is to show a bit, go through the report, the front cover, if you could show it, Beatrice, and then probably also the table of contents and the table of figures, because you will see this is the front cover. You can download it from our website, but if you go down, you will see we have, of course, the acknowledgement, then the table of contents, but also the next page, you will see the number of figures. I mean, Apostolos has done enormous work, previous page, yes, in analyzing markets. There is plenty of data in the report in a, I would say, rather shorter paper of not even 50 pages, so 45 pages, but plenty of data, as also Alan was saying, but the same data as we know from many times, but certainly data which we look at in a different way, or probably analyzed in a different way than we have done. I see that also one of the other members, Philippe Bordenave, who's with BNP Paribas, wants to raise a point. Philippe? And you can take the report away, Beatrice, thank you. Yes, Philippe, you're on mute.
Okay.
But we don't see you, Philippe. Yes.
Yes, thank you.
Good morning, Philippe.
I wanted to just to bring a compliment to the answer, just the previous answer about listing for SMEs. I think that as a good compliment about the listing for SMEs, which can bring equity to SMEs. One of the issues to raise capital for SMEs is to find enough long-term debt or mid-term debt for their investments. And to that respect, securitization is a kind of hybrid way to give them access to capital markets as a group, if you want, and not individually. Individually, the amounts are not big enough to raise interest. It creates some liquidity issues on each issue, but securitization is a way to bring the SMEs together as a group to the market through the traditional funding, initial funding through banks. And I bring also a complement of answer to the previous question about securitization. One of the big potential of securitization is really the SME debt in the bank's balance sheet, where because the risks are significant and banks have a limit to what they can take in their balance sheet, given their capital requirements that are even in the process of being worsened with Basel IV. And so in order to bring all the funding which is required by SMEs in those times, the capacity for banks to unload the risk through securitization is key, because it would increase the volume they can originate and then distribute through securitization. So the securitization has to be seen as a kind of hybrid way of developing capital markets for the SMEs.
Thank you, Philippe. We've seen this chart which Apostolos showed a moment ago about securitization in Europe, that basically since the financial crisis, since 2008, it has not picked up at all. It remains at very low levels, and it's a fundamental element if we want to reduce, as also Apostolos showed, the size of the balance sheets of banks in Europe. We need to have a more active securitization market, and apparently we're not getting there.
Or to allow them not to increase the size of their balance sheet, but to bring more money to the economy.
Okay, I look back to probably if Lieve still wants to add something, because we're coming to the end of this presentation, or if somebody else has raised the point. I see there was another question from another member, but that has been replied already by Alan on the Nordic model. Lieve, you want to add something from what you heard, from what you see?
Maybe I would say that this webinar is very encouraging. I think it confirms what the working group has been thinking about and working towards, is that we have here a number of very, very specific, targeted ideas that we believe that can be a pragmatic contribution to what we have called in the title, the re-energization of the European capital market. So I really hope that this can be a starting point. This study is certainly not an end point, but that can be a starting point to contribute to that pragmatic approach based on the positive examples that we indeed already have from the Nordic markets to re-energize capital markets in Europe. Thank you.
Okay, so with this, we're almost at the end of this webinar. I don't know if Apostolos still wants to add something from his perspective. Yes?
No, just one thing related to the last question about the Nordics. And one of the, in my expertise, the markets also tend to be most of the open markets in Europe, not only developing homegrown expertise, but also inviting non-EU market participants to sell products in the market. So could this model of open capital markets be an example? Yes, I mean, it could be an example. I mean, of course, we're talking about also making Europe competitive and attractive. And to do that, Europe has to remain as open as possible. We need to be open. We need to be open to international market participants to come, invest, and participate into the markets. But for this also, we need other things, as Liv also mentioned, in terms of we need stability, we need continuity of the regulatory framework, we need the regulatory consistency of supervisory outcomes, and we need also a lot of things in order to create an accommodative environment for non-EU players and market participants to come and invest in European capital markets. So open is the way to go.
Okay, thank you, Apostolos. It remains me to thank, certainly from behalf of CEPS and ECMI, the members of the roundtable. You will find the names in the report. So first of all, Lieve for having chaired this group and having also sponsored this on behalf of Euroclear, our work on this subject, but also to thank the different other members, Philippe Bordenave, Jos Dijsselhoff, Luca Garavoglia, Jose Maria Linares, Alan Pollack, David Schwimmer, Bjorn Sievern. So all people really in the markets, very high level group, which I think was fantastic that we could have this. But also the rapporteurs, Apostolos, whom you heard extensively, and also Nim Veloni, who could, as I said, unfortunately not be here today. But Nim also, as I said, had a very important contribution and will certainly continue to work on these regulatory issues related to capital markets in Europe. And then finally, to thank also Beatrice, who has helped us, and other colleagues within CEPS, Cosmina and Ornella, let's say, to have this report done, have it finalized, and have it presented to you today in time. So with this, let me thank you for your participation. We had almost 80 people at some stage, so there's a lot of interest. And the report is from now onwards available on our website for download. So thank you very much, and please stay with us and then give us your ideas on how we can continue to work on this matter. Thank you.
Thank you very much.
Thank you, Carol.
Thank you, Alan.